Hello everyone, welcome back. Here's a trade recap. I took a trade in the USDCAD on Friday, and a model of which I just released, the TGIF model, was what I used. So this video is going to briefly explain how I went about it. Okay, so here's the USDCAD, the weekly time frame. Now, remember, you have two things you are looking out for that helps you qualify when to use the TGIF model. Number one, a higher time frame PDRA has to be met, which could either be an order block, fair value gap, run on liquidity, or a breaker block. And it must happen on either the monthly, weekly, or daily time frame. Okay, so looking at the price, if I draw my feet from this level here, from this low to this high, why am I drawing it from this low to this high? I'm trying to determine the daily range. Okay, so this is a daily range high, and here's the daily range low. Why? Because it has taken what buy side liquidity, and then this midline here is what equilibrium. Above equilibrium, we have premium. Below equilibrium, we have what discount. We want to be buying at a discount and selling at a premium. What does that mean? It means that you get more profitable trades if you sell at a premium, and you get more profitable trades if you buy at a discount. Now, it doesn't mean that you cannot buy at a premium, okay? But when you buy at a discount, probability of you taking a profitable trade is much more higher. Now, you can see what the price has done. Price left what? A fair value gap, a monthly fair value gap at a premium at this point, rallied lower to take liquidity, sell side liquidity at a discount. Now, once this happens, we have what? A weekly PDRA met. You'll notice that this daily range has been divided into 4 quadrants. We have 1, 2, 3, 4. With this point here being the premium and here being the discount, this is the equilibrium. Now, each of these lines could serve as what? Support and resistance. Most of the time, when you find a PDRA nested with any of these levels, it increases the probability of that level in holding price. All right. So because you can see here, we have what the 75% level here, nested with what run on liquidity at a discount, which increases the probability of price rallying higher from this point. All right. So let's go down to the weekly time frame. Now you can see price took out liquidity on the weekly time frame with this run. Okay. Now, if you look at these levels, you'd see how price found support and resistance. You can see this candle here, found support, found resistance. Here again, you can see how price found support, resistance, resistance. This candle here found resistance. So it's not random, guys. And then here again, you can see resistance nested with what? A breaker block. This down close candle. See how price ran higher. There was resistance here and then fell. Okay. So now we're going down to what? The daily time frame. So here's the daily time frame. Don't forget these are down on liquidity. So let me, so it's a liquidity and then the 75% level. This is what? Tuesday. This is Wednesday. So I'll outline Tuesday. This is the high of the week. Tuesday being the high of the week. And you can see how it ran higher into this area of inefficiency, the fair value gap, before falling. Now, looking at this weekly range, you can tell easily that price is bearish, okay, which is the second condition that must be met before you apply what the TGIF model. So the first is a higher time frame PDRA should be met. The second is the weekly range should have a clear direction, and here we can see price was bearish. Now, the second thing that also increases probability, it must not be there, but it increases probability, is that you want to see Friday take what? The previous daily low or previous daily high. So because we are buying, we want to see Friday take what? The previous daily low, which is Thursday's low. This is Thursday, and here's Friday. So we're going to go down to the 1 hour or 15-minute time frame to look for what? A market shift. So we're going down to 1 hour. Good. So you could see the run on liquidity, which happened here. All right. Now, looking at the 1 hour time frame, the market shift isn't very clear. So we will be going down to the 15-minute time frame. Remember, I said it mustn't be the 1 hour and it mustn't be the 15 minutes. It's either of the two. Which one works best for you? Where you can see clear market shift with a fair value gap. That's the time frame you want to be using. So if we go down to the 15-minute time frame, this is the run on liquidity. So I'll just take it to this point so it doesn't mess up the chart. Okay. Now, if you look closely, this is our 75% level. So here's a 15-minute time frame, and you can see a market shift. Price took what? Sell side liquidity, and did what? Broke structure. So I will outline it for us to see. All right. So you can see how price ran liquidity. Now, this swing that took the sell side liquidity, you will note how it ran higher to break this higher, which is what we call break of structure. Now, once these two things happen, we have what? A confirmed market shift. So the next thing you want to do, which is the conservative method, you want to use the fair value gap, which was formed. Now you can see that there's a fair value gap here at this level. Now, note how price dipped into this fair value gap before running higher. And this was happening where? The New York session. So you want to be trading the USDCAD and the New York session, not London and not Asian, but the New York session because of the pairs. Both the USD and the Canadian dollar move with high volatility at this session. If you look to the left, you will see we have what? Buy side liquidity. And here was the high I was aiming for. So let's go down to a smaller time frame to look for entries. Now, remember I said in the 3-minute time frame, 1 minute or 5 minutes, what you're looking for is a market shift or change in state of delivery. Now, if you look at this price action here, what do you think happened? The market shift occurred. The same thing that happened in the 15-minute time frame also happened in the 3-minute time frame. You could see as price dipped into the 15-minute fair value gap, it ran higher to do what? To break structure. This was a swing that fell into this fair value gap, taking what? Sell side liquidity. As soon as price runs high to break the high of that swing, we have what? A market shift. Now, once you note this market shift, you want to identify the fair value gap that was created as price displaces higher. And here we have the fair value gap. Actually suffered a bit of drawdown here. So it's not easy, but I held on to the trade because of my conviction or understanding of how price moved using the TGIF model. And here you have it, you can see how price rallied higher towards the buy side liquidity. I think this was a 1 to 4 hour. So if you use your buy to, you would see that it was up to 4 hours. All right, you can see it was up to 4 hours. I was actually aiming for the fair value gap at the daily time frame. If you look closely, we see we have a fair value gap. This was where I was expecting price to get to. But if I should use my measuring tool, because I expect 20 to 30% retracement, here you can see we got what 30% retracement, which was just very close to that high. So this was the buy side liquidity we're aiming for. You can see, but then I allow price to run higher to take this buy side liquidity, and I close my trade. All right, guys, I hope this was helpful. Please, if you enjoyed this video, give it a thumbs up and do subscribe if you want to get more videos from this channel. See you guys next week.